Welcome and thank you again for subscribing to the video series. Today, I'm super excited to share about velocity banking, how to pay off a 30-year mortgage in 7 to 10 years without increasing your monthly cash outlay. I'm going to show you today how to use the bank's money to pay the bank, specifically through a case study of how to pay off a 30-year mortgage in 7 to 10 years without increasing your monthly cash outlay. First, let me give you a little bit of background about how to use the bank's money to pay the bank and what that actually means. It's a term we like to call velocity banking. This is a concept that has become more popular recently. This was originally the way banks out of the country operated. In Australia, if you were to go buy a home, you wouldn't get a loan from the bank. You would get a line of credit. And that is the basic premise of velocity banking, using lines versus loans. Before I get into the case study, I want to make clear that this strategy is all about using your available cash flow more efficiently. So let me show you what I mean. Traditionally, when you have $5,000 of income, we're going to use a household income of $5,000. This is after-tax dollars. Where do we traditionally put that money? After taxes, it normally will go to a checking and savings account. And then from our checking and savings account, we're going to spend a mortgage payment of $1,200, a $200,000 home, maybe a car payment for $600, a credit card bill for $600, and then some miscellaneous expenses, groceries, gas, insurance, those kind of things. A lot of people may not think they have savings, but they actually do. 401k, maybe a life insurance policy, wherever that cash is being utilized, I'm going to call it savings. And in this case study, I'm going to use the number of $1,400 of savings, whether that's retirement accounts, life insurance policies, annuities, different things like that. Before going any further, first, we need to realize and identify and acknowledge that lines and loans are two very different banking tools. Number one, loans are a one-way tool, which means when you make a payment to the bank, that money is gone. You do not have access to that payment anymore. Whereas lines is a two-way tool. When you make a payment of $600 to your credit card company, what's available immediately? $600, less any interest that you pay. The second thing we need to be aware of and acknowledge is that the interest is calculated differently for each of these tools. For a loan, the interest is an amortized payment, which means interest is paid up front and compounded over 30 years. Whereas a line of credit is simple interest. It is calculated on an average daily balance. Let me illustrate this a little bit further. Which is more, 21% or 6%? So if we're looking at our example from the last slide, a credit card of 21% and a mortgage of 6%. Which is more? Let me put it a different way. Which is hotter, 32 degrees or 1 degree? Which is hotter now, 32 degrees Fahrenheit or 1 degree Celsius? So if you know your degrees of measurement, you'll know that 1 degree Celsius is actually hotter than 32 degrees Fahrenheit. And the only reason I use this illustration is to point out that the numbers have nothing to do with each other. 21% simple interest versus 6% amortized interest, two very different types of measurement, two very different types of interest and how it's calculated. Let's take a look further at the $200,000 house in this case study, an amortized loan at 6%. The red line represents the interest that you're going to pay over time, and the green line represents the principal. When you put both of those together, it gives us this number, total mortgage payment, $1,200 times 360, which is $432,000. Do the math on that. The house that you purchased was $200,000, but you're going to pay $432,000 for the entire home. You're paying for two, but you're getting one. I don't like those deals. I don't know about you, but I don't go to a deal at a store for buy two and get one, right? But we sign up for this. We don't question it. This is just the way things are, and they don't have to be. So that's the whole point of this. This is not the way that you have to bank. There is a different way. There is a solution to this. I'm going to illustrate this even further. When you look at the payment schedule, so your first payment is mostly interest and your last payment is mostly principal. And we know this stuff, right? But again, we don't question it. When you look at how much interest you pay at about this point right here, which is going to be about, 50, 60 months, okay? First 5 years. What do banks start sending you in the mail? Possibly the rates are lower. Maybe the interest rates are down into the 4% range now. So they want you to refinance, adjust the rate and term, and start the loan all over again. Well, this is why, guys. When you look at when they send that letter out, you've paid $54,000 of interest and reduced your mortgage down by only $13,000 of principal. That's why they send that letter out to you, because they're going to capture 50 grand again from you if you choose to refinance. So let's question this. Let's eliminate this process with just thinking a little differently and using our cash flow more efficiently. I'm going to illustrate even further. What we need to do is we need to utilize our cash flow in a different way. So we're going to recover the $1,400 that is going to a traditional savings account or wherever that savings money is going. We're going to use it differently. We're also going to leverage our line of credit. And so that payment of $600 that's going to the credit card, we're actually going to be able to use that differently by using this strategy of velocity banking. So now if you saw that, you have $2,000 of cash flow to play with and to work with and to use more efficiently. So now, if you take a look, we do have a credit card payment though, right? So this credit card that we owe $13,000 on, this strategy only works if you take all of your income, every single dime, $5,000, and you put the entire $5,000 onto your line of credit. And when you do that, your $13,000 balance will come down to $8,000. And now what? Now we have all these expenses, right? You got to pay for your mortgage, you got to pay for your car, you got to pay for the miscellaneous expenses, and that's fine. So $3,000 will come off the line in the form of an expense, leaving on the 2, and then that's month 1. You do it again. There's month 2. Maybe in that 3rd month, you have some expenses that come up that ordinarily wouldn't. Maybe you had a flat tire and you had to fix the tire. You can spend more, and that's okay, because you have a line of credit with all the access up to $15,000 of limit. So you repeat this process over and over and over again. Your income going on the line, your expenses coming off the line, over and over and over again, and you'll have this credit card balance of $13,000 paid off in 6.5 months. Okay, now you have a credit card with a 0 balance. What do we do? How do we attack our biggest debt, which is going to be our mortgage? Now what you're going to do, you're going to take a $13,000 draw from your credit card, the one that you just paid off, and you're going to put it as a principal only payment onto your mortgage. And then what you do is you carry out the same strategy. 5,000 on, 3,000 off, 5,000 on, 3,000 off, 5,000 on, back and forth, back and forth, back and forth. And now in 6.5 more months, you have just now reduced your mortgage by $13,000. And the beauty in this, guys, take a look. The interest that's calculated on that $13,000 of credit card interest at 21% interest equates to about $1,300 for that 6.5 months versus $54,000 of interest in those 56 months and paying off the same exact amount of $13,000 of principal. So in 6.5 months, you've reduced your mortgage by the same amount that it would normally take in 56 months. I don't know about you guys, but I would much rather prefer to pay $1,300 versus $54,000, right? This is the key. Now that you've been made aware, what can you do with this? If you carry this out for the next 7 to 10 years, you'll have no more mortgage payment. It'll take you only 3 months to pay off a car, and you will officially have no more debts that are not assets, that aren't paying you money. You take a look at your cash flow. It started at $2,000. You recover the mortgage payment. You recover now your car, and now you have $3,800 to work with, to play with, to invest with. And this is so exciting. When I first saw this, there were basically 2 reactions that you could have had. Which one are you guys? You might be this, where maybe you've been paying your mortgage for like 29 years, right? And you're just like, no, why me? Or you could be the person that maybe hasn't bought a home yet, and You're now privy of how to bank a little bit differently. Maybe you're excited because you can pay off your student loans now using this strategy, which is what I did. Here's some things to think about though. First, this is math. This is straight up math. This is nothing magical. This is nothing about magic. This is not a scheme. This is not a gimmick. This is math. The wealthy bank like this for any kind of liability. Have you guys applied for any kind of a refinance lately? And if you have, what do the banks offer you? I doubt they're ever offering you a line of credit, right? Because it doesn't make them money. Why do the banks want you to refinance? Because they want you to start the term all over. And the most expensive part of the loan is at the beginning. So they want you to refinance as often as you possibly can. Some results: Alice was watching a similar presentation as the one you're watching right now, and she decided to make a discovery call and learn a little bit more about how she could implement this strategy. And she actually paid off $85,000 of some liability debt in 2 years. Then she learned how to use equity in her home to start investing in real estate. And she's flipped one property already, and she actually has got another one due to close in just a few weeks here. Exciting stuff. So are you thinking, how can 21% still be cheaper than 6%? If you are, I get it. But here's the truth. Lines and loans are two very different banking tools, and we have to understand that. And all this strategy is using your cash flow more efficiently. And remember, the banks don't want you to know how to do this. They would have to invest in smaller buildings. They just wouldn't make as much money if you knew how to bank like this. That's the truth. That's the velocity banking concept in a nutshell. But I want to give you a little bit more information of how to take things to the next level. In previous videos, you're learning the benefits of becoming a business owner and becoming a real estate investor. Let me show you what you can do as a real estate investor. Now, I'm going to use the same case study where this house is now paid off. The home that you just paid off, the $200,000 home, there's no leverage on it. So now what you're going to do is go to a bank and request a home equity line of credit. If you go to a bank, they're often going to offer you up to 80% of the value of the home in access. So basically, you can think of this as a credit card that is collateralized by your house, up to $160,000 of limit. And what you're going to do is you're going to make a down payment on 6 rental properties. These rental properties are going to be $100,000 each, and you can find those all throughout the country, even cheaper than that. And in order to purchase a property, you need to determine what is your cash flow requirement. So in this case study, each rental is going to generate $400 of passive income per door. So a total of $2,400 of passive monthly cash flow. So you take a line of credit, you make a down payment on 6 different homes, so $120,000, leaving room in the credit, so you're not going it to the max amount that you can. And when you start generating that passive income, your cash flow will increase to $6,200, and then you start utilizing the same strategy that I showed you in the previous examples, and you'll pay off the line of credit, the $120,000, and you will literally have no debt that is a liability any longer because the rentals are satisfying any other mortgages or loans. I don't know if you guys realize this, but when you do this in a few years, this could be you. You could have your 38 initial $100 of cash flow, 6 homes that are going to be now generating $1,000 each because you can start paying off those debts every year. This would equate to nearly $10,000 in cash flow in 7 to 10 years if you were to carry out this entire case study for yourself. Most people would be elated to be able to retire in 10 years from now, right? Rinse and repeat, rinse and repeat. And I realized you might be this guy right here, drinking water out of a fire hose. And that's what I was like when I first saw this presentation, and it changed my life. So I invite you guys to learn a little bit more. Continue to invest in your education. This is what I've covered today. So you've learned velocity banking in a very brief concept, how to use the bank's money to pay the bank, and what's possible when you do it, and how to accelerate your wealth through some real estate investing and buying real estate and rentals. What I showed you today is a snippet of an 8-hour course called Velocity Banking within the Renatus Essential suite of classes. Again, this is 11 full-day courses taught by practitioner instructors, experts in their field. And what I showed you is a 10-minute presentation that tries my best to explain the concept of velocity banking. Velocity Banking is an 8-hour course that will walk you through exactly how to implement it and what tools you'll need in order to implement it for any kind of debt that you have that you no longer want. And there is a solution to this problem to streamline how to get out of debt quickly. It's through more education, investing in your education, learning how to access properties, producing more income for yourself, and being supported by a community. I'm not talking about academic education, guys. Learn from seasoned investors and practitioner instructors how to find cash flowing properties like clockwork, generate a commission or an income based off of sharing your success while you're becoming a real estate investor and business owner, and be supported and mentored by a nationwide community. Guys, if this is what you're looking for, if you're looking for a solution to bridge the gap of living a life of default and a life of design, I encourage you, don't hesitate. Click below to schedule a discovery call. And what we'll do on that discovery call is I will demonstrate how quickly you could pay off your debts using a velocity banking calculator. I'll show you how to use it, and then I'll also send it to you in an email after our discovery call so that you can manipulate the numbers and see how quickly you could pay off your largest debt and most inconvenient debt. I look forward to hearing from you. I look forward to our discovery call. Don't hesitate, guys. Take the initiative to make the call now. To your success, I'll see you in another video.